Usually, new economic strategies, even reckless ones, come with a honeymoon period. There are time lags before the consequences are felt. And a burst of government spending will initially boost growth, even if it is funded by printing money. But for Trump's second term in office, the honeymoon has been exceptionally short. Growth is already slowing, despite being boosted by an unrelated boom in AI spending, and inflation is creeping up. Problems are beginning to accumulate. Ray Dalio, founder of the world's largest hedge fund, Bridgewater Associates, says we are heading for very dark times and predicts that there will soon be a debt-induced heart attack in the global economy. 16 Nobel Prize-winning economists have signed an open letter. They have warned that Trump's policies will reignite inflation, undermine institutions, and destabilize America's position in the world. And Mark Spitznagel of Universa Investments has predicted the stock market will crash by 80%. The thing is, we have been here before. In this video, we'll show how the US economy followed a very similar path not too long ago. The ending then was brutal, and there is little reason to believe it will be different this time. The impact of President Trump's Liberation Day tariffs are already being felt. Paul Krugman, a Nobel Prize-winning economist, warns that the tariffs are creating a significant inflationary shock and imposing a significant drag on economic growth. And investor Ray Dalio says the tariff effect is similar to tossing rocks into the production system. You see, this isn't some cleverly thought-out protectionist strategy. It's like economic sabotage, designed purely to appease a populist base. And the real irony is that tariffs don't even work. Tariffs don't reduce the deficit, and in a moment I'll show you why. But first, let's look at what's happening right now. According to the nonpartisan budget lab at Yale, the 2025 wave of tariffs is already cutting nearly a full percentage point off US growth, while at the same time pushing up prices by more than 2%. Ernst & Young report a similar situation. They warn that growth will slow to about 1.7% in 2025, down from almost 3% last year, while core inflation keeps drifting higher, toward 3.2%. And if it weren't for the sudden surge of AI investment, the slowdown would feel even worse. Economists at JP Morgan calculate that without that AI spending boom, US growth this year would be more than 1 percentage point lower. Put another way, growth is stalling, prices are rising, and both businesses and households are being squeezed. The ironic thing is that these tariffs are not structurally boosting America's trade position. In fact, they are self-defeating. Most people don't realize that the Chinese trade deficit is primarily caused by China buying US financial assets like treasuries. When China sends money into America's capital markets, the balance of payments means there must be a matching trade deficit in goods and services. That's why tariffs don't work. Cutting imports will cut exports by the same amount, a rule called Lerner symmetry. The only way to reduce the deficit is to prevent China and other foreign countries from buying US debt. And with a rapidly increasing deficit, that's not going to happen. The US government needs to borrow, and that means capital inflows are more important than ever. The second risk to the economy is a more subtle but equally destructive policy. It is the attack on America's economic credibility. Every modern advanced economy relies on independent institutions, statistical agencies that report the data honestly, central banks that set interest rates without political pressure, regulators that enforce the rules consistently. Without them, markets lose faith. However, President Trump places little value on these institutions. He has sacked officials, questioned official statistics, and publicly berated the Federal Reserve. The mere threat of firing the Fed chairman or board governors is enough to spook investors. Markets have wobbled a few times already, stocks dipping when Trump escalates his threats, before recovering when he backs down. Admittedly, recent wobbles are more muted than during his first term, but are still significant. The most notable recent comment was on April 21, 2025, when Trump renewed attacks on Jerome Powell, calling him a major loser and demanding rate cuts. On that day, the S&P 500 fell about 2.4%. And in the Treasury bond market around that time, the yields had been under heavy stress. the 10-year yield surged up to about 25 basis points to 4.5% after a sharp sell-off, one of the biggest weekly jumps in more than a decade. However, if Trump were to actually follow through and fire the Fed chairman to force a reduction in interest rates, the outcome would be disastrous. Long-term interest rates don't just reflect today's Fed policy. They reflect trust that America will manage its finances responsibly in the future. The irony is that by trying to bully the Fed into cutting rates, Trump could set off a chain of events that pushes them even higher, raising borrowing costs for households, businesses, and the government itself. Paraphrasing JP Morgan's Jamie Dimon, the independence of the Fed is absolutely critical. Playing around with it can often have adverse consequences that are the absolute opposite of what you were hoping for. Donald Trump's Big Beautiful Bill is one of the most sweeping pieces of US legislation in decades. Passed on July 4, 2025, it bundles together permanent extensions of Trump's 2017 tax cuts, higher deductions, and new write-offs for tips and overtime. On the downside, it slashes Medicaid funding, imposes work requirements on recipients, raises taxes on university endowments, and strips back subsidies for green energy while boosting fossil fuels. The price tag is enormous. The Congressional Budget Office estimates the bill will add $2.4 trillion to the federal deficit over the next decade. To put that in context, that's about 8.5% of US annual GDP, debt that will have to be financed in an environment where interest costs are already crowding out other spending. Supporters argue the tax relief will unleash growth. Critics warn it will deepen America's fiscal hole and tilt benefits toward wealthier households. The initial market reaction has been muted. Stocks edged higher, bond yields rose only modestly, and the dollar firmed. That is mostly due to relief. Investors prefer certainty, and passage of the bill ended months of political wrangling. The other factor was timing. The law was signed alongside stronger than expected jobs data, which temporarily lifted sentiment. But underneath the calm lies significant concern. With deficits swelling and debt climbing, the muted reaction is unlikely to last for long. Pitched as a strategy for growth, in reality, it's a fiscal time bomb. And there is rightly a worry that Donald Trump will reignite inflation with his fiscally irresponsible budgets. That conclusion isn't penned by me. This is a statement signed by 16 Nobel Prize luminaries, including Joseph Stiglitz and Robert Shiller. The thing is, we've been here before, and the warning signs are unmistakable. 10-year bond yields have recently touched 5%. The last time they were consistently at this level was the 1990s, but then the trend was downward, inflation was under control, and the fiscal outlook was improving. Today the situation is the reverse. Rates are back at 5%, but this time they're rising, not falling. And the closest comparison isn't the 1990s, it's the 1960s and 70s. Back then, the US was funding the Vietnam War, as well as generous social programs initiated under LBJ's Big Society. Like today, cutting spending was politically impossible. Financing became tighter, rates rose, and in desperation, President Nixon ended the dollar's gold convertibility in 1971. Subsequently, the Fed came under huge pressure to ease credit, which it did, flooding the economy with money. The result was stagflation, high inflation, weak growth, soaring unemployment. It took brutal austerity in the 1980s, sky-high interest rates and deep recessions, to finally bring the system back under control. Today's situation looks remarkably similar. Rates already look almost certain to creep higher, taking them closer to 7%. If that happens, the cost of financing America's debt load above 125% becomes excessive. Balancing the books becomes nearly impossible. So, is there any reason to believe this could end well? Commentators often point to Japan's extraordinary debt levels at 230% as a way of justifying higher spending. But the difference is, Japan has been able to lean on domestic institutions and pensioners for funding the debt, often at a loss, at levels around 1.5%. This is due to cultural reasons that are not shared in the West and are not comparable. The other option that could support Trump's expansionary policies comes from modern monetary theory. It argues that the Fed should buy government debt directly, essentially monetizing the deficit. But that would unleash a tidal wave of new money. Inflation would soar, the dollar would weaken, and America could slide back into a 1970s-style spiral of rising prices, collapsing confidence, and deep social unrest. Unfortunately, the outlook is bleak. Trump's policies are laying the foundations for a crash, one that will probably strike during his current presidential term. His tariffs are slowing growth and raising inflation. His attacks on institutions are destroying trust and causing investments, in particular foreign capital allocations, to be cancelled or postponed. And debt levels are spiralling out of control and are being financed at increasing costs by markets that are losing patience. The best hope is that Trump changes course if interest rates increase further. The last chance to embrace austerity and stabilise the debt load in an orderly way would be if interest rates approach 7%, which seems increasingly likely. Realistically, however, the chances of that are very small. Instead, the president has already been increasing pressure on the Federal Reserve to hold interest rates down and to tolerate larger deficits, an approach that risks reviving the kind of persistent inflation last seen in the 1970s. And if that happens, history shows the correction won't come through gentle adjustments. It will come through the kind of drastic monetary and fiscal tightening Paul Volcker imposed in the early 1980s, when a brutal recession was the price of restoring stability and credibility. Which means Trump's next move won't just shape the next few years. It could define the credibility of America's institutions for decades to come. I hope you enjoyed this video. If you did, then please like, subscribe, and comment. Thanks for watching.